let's use some problems, some of these exercises to take a look at these different methods, okay? So the first thing I wanted to hit was the gross profit method. Last time, remember, we calculated the difference between gross margin markup. Everybody's good with that? So what we've got then is, in exercise 912, is these guys use the gross profit method to estimate their inventory for monthly reporting purposes, and this is for the month of May. What else might you use this method for? If you have cash good loss, inventory stolen, or inventory burns up in a fire or whatever, right? You lost inventory. If you had that happen to you, then you might use the same method to determine how much inventory was lost or stolen. Is that the idea? That's right. So, but this is also good for doing monthly statements, quarterly statements, anytime you're not doing the physical inventory. But who would do this, by the way? You're not keeping perpetual records. These are periodic folks, right? Okay, if you're keeping a perpetual record, you already have an estimate of your inventory, which is probably a pretty good one. You keep track of everything coming in and everything going out. Okay, so this would be where you just debit purchases when you buy it. You don't know how much you sold. You don't know what cost of goods sold is. So what we're going to do is we're going to estimate cost of goods sold and thereby estimate the inventory. Okay, so they're going to do it two different ways. They say what the inventory is, what the purchases were, what the freight in is, what the sales revenue were, sales returns is, purchase discounts were. Hey, fine, and they want to estimate the inventory assuming gross profit's 30% of sales, and then let's do it with 30% of cost. So kind of another problem doing what we did last time. So okay, in A and B are going to basically do the same sort of thing. I start with my beginning inventory is 160, huh? My purchases at cost were 640. Of course, you take away your purchase discounts. You'd also take away any returns and allowances if you had them, right, guys? And you add freight in. You guys know how to calculate goods available for sale, right? Okay, so it's net purchases. Purchases plus less discounts plus freight in, right, is your net purchases. Add that to the beginning inventory, and you've got what's available. Okay, if we could calculate, so if you know what's available, it's a problem. If you could calculate, now what did I do? Stop. Okay, anyway, if you calculate what's available here, 818, right, then if you knew the cost of goods sold, you could subtract the cost. This is going to be the cost of goods sold. They have it labeled kind of strangely. It says sales and cost, but it's obviously cost of goods sold. If you estimated your cost of goods sold, you could subtract it from your goods available, and that would give you your approximate ending inventory, wouldn't it? That makes sense? That's all they're doing. Okay, and I don't know why the author always does this with this gross profit method. They want to take 30% times the net sales. You see the sales are $1 million. They had some sales returns. If you had some sales returns and allowances, so that's the net sales. If you had sales discounts, you take that out too, right, guys? Okay. So your net sales at selling price are 930, right? For some reason, they take 30% times that, get the 279, and then subtract the 279 from the 930. I don't know about you, but if the gross profit percentage is 30%, I think the cost percentage is 70. 1 minus the 30%, I just take 0.7 times the 930, and if you took 70% of the 930, what would you get? Cost of goods sold 651. I don't know why they have that step. And they do it every time they work one of these problems in this book, but you don't have to do it that way, of course. Why would you multiply and then subtract when you could just multiply? Anyway, it's not a big deal, but I think it's a little more straightforward. So then you take your net sales here, less the cost of goods sold, and you get your ending inventory cost. Let's say it had been a fire. You had a fire, and you go and count the inventory that's left. It's not damaged. And you cost it all out, and it's 50,000. And then you calculate you should have 167, and you do have 50 on hand. What do you think your loss is? 167 less than 50, wouldn't it? A loss of 117. Lots and lots of problems have you do that. So I'll give you a couple of those, right? These are yes, right? Okay, this is easy stuff. Everybody good with how this gross profit method works? Okay, we call it the gross profit method. Right? And you can use it every month, couldn't you? Don't you always know what your sales are? Don't you always know what your beginning inventory is? Right? Rolling forward month after month. Don't you always know what your purchases are? So this is easy to do, right? Calculation simple. Okay? Is it very accurate? No. But what are you going to do at the end of the year? count the inventory, cost it out properly, and make sure you get the right cost of goods sold. Right, gross profit. Pretty exciting. Okay. What would you do if we didn't know the 30% on sales price? Now what we're saying is what, you guys? This one is sales price, cost, gross profit. Looks like this, right? They said this is 30% of this, right? Everybody good? Gross profit is 30% of sales, and therefore I know this is 70%. You guys agree with me? What about, though, if they tell you, that's in part B here, right? On 912. Compute the estimated inventory May 31st, assuming the gross profit is 30% of cost. Now what I got is my sales price, my cost, my gross profit. This is 30%. Well, what's this one? That's the 30%. Okay, this is 30%. What's this one? Yeah, that's all we're doing. So what they suggested you do here, right? They got exactly the same calculation. They're taking their beginning inventory, adding their purchases, right? Subtracting their purchase discounts, adding the freight in, and they get available for sale. And what we're going to try to do is compute the cost of goods sold. This is cost of goods sold, of course, right? And they get the approximate in the inventory, okay? So same type of idea. Just convert this into, make this 100%. So let's do that, okay? How would you do it? Take 1.3 and divide it into 1.3 to give you the 100%, right? What's 1.3 divided into 1? What is sales price? That's all we're doing, right? Just like we did last week. Probably.
77%.
This is about 77%. So what must the cost be? That's 30% divided by 1.3, which is obviously what, 23% about? Which is 77, 23.
Yeah.
When they calculated, they got it 23.08. Okay? Everybody good? So what I do is I take the 1 less the 23.08, right? Which is my gross profit percentage, right? My markup was 30%. My gross profit percentage is 23.08. So what I do is I take 1 away from that. What would that be? 76.92, is that what that is? I take the 76.92 times the 930 goods, or the sales rather, right, net sales, and I get my cost of goods sold of 715,356. Subtract that from the goods available of 818, and what do you get? 102,644. Everybody see what's going on? Did you do this? So this time, if I had 50,000 left when I went and priced it out, what would I think my loss is? 50 away from 102,644. Okay. They give you that in the problem, but I will. I'll give you a loss, probably. Give you calculate in the inventory for doing financial statements too. So again, all right? Okay, let's do some tougher stuff. No, maybe tough. We were talking about what makes things hard. None of these things are hard in this chapter. It's just the little twists and turns in it, right? We've got a variety of methods we're going to use. We've got a variety of methods we're going to use. Retail methods. By the way, who would use these retail inventory methods? These are all retail inventory methods. What kind of companies do you think might use retail inventory methods? Retail. How about retail companies? People who are selling product to the general public. What's a unique thing that they have? They easily can find the retail sales price they're selling. Go to Walmart, go to Kroger, right? I don't know what else they use, they use much or not. But when you go into the store, is there a bin, right? Shelf, right? A bin with everything they've got, right? There's a bin there with their products. The green beans are there, the milk's there, whatever it is, right? Produce is there. And attached to each one of them is a what? Right above it, right below it. Price. You know the sales price. So how easy is it to get the retail sales price when you are counting the inventory? It's a snap. Just count the inventory, write down the retail sales price. then you don't have to go look up all these sales prices. Got it? Okay. Now, if you're computerized, so probably with Kroger and Walmart, maybe they're not good examples because they are computerized and they really want to control their inventories. So they're doing perpetual inventories anyway, right? These are probably people without perpetual inventories, right? Okay. And then you think about, well, if I've got it perpetual, I've got it all computerized, I've got the sales price in my computer, but I also have the cost of my computer. I can use the cost of my computer. But if I'm periodic, I've got to compute that inventory, don't I? I can save me a whole bunch of money to write down my inventory count, write down the retail sales price, and figure my inventory at retail sales price, which is just multiply, right? The quantity times the retail sales price, which I can add them all up. You got your inventory at retail. Then what would you do? Take that sales price, total inventory, or sales price times what? Cost of goods sold percentage. That's all we're doing. And that would give you the inventory cost. An estimate of it. Okay? So good to save companies lots of money. Yeah, it used to be lots and lots of companies that use this stuff. Now fewer do, but what happens? So if people are using methods, and then they could change to something else, but what do we tend to do? Think it's expensive to change. Leave it the way it is. So companies are still using this stuff, okay? Right? More than you would expect. Sort of like when we look at dollar value LIFO. Companies are using dollar value LIFO, right? Well, we actually, well, we computers. Is there even a huge savings anymore? Well, I don't know. The initial conversion might be kind of expensive, huh? Right? The initial setup. So, okay. Anyway. So, what are the ways that you could do this? They have one that they just call retail inventory. It's really unfortunate that we don't put a different name on that. What it really is average. If I'm going to do an average, right? Kind of weighted average, basically, I suppose. Weighted at the beginning inventory plus everything I purchased. It's kind of a weighted average. So average would be just called retail. Okay? So if I say it's just a retail method, or I'll say it's average and it's retail or something, that's what it looks like. So there's one. Okay, that. Okay? And then we've got one that approximates lower of cost or market, and that's called conventional. So when you read this chapter, you're kind of like, what are you talking about? Right? Lower of cost or market. Those are the same thing, right? They're not two different ones. And sometimes they'll say conventional, and sometimes they'll say lower of cost or market. Same thing, okay? Same one. I guess we conventionally use lower cost or market. Okay? All right? Then what? We've got to have one, but it's what? So this is life for retail. So this conventional lower cost or market is retail, right? Because obviously we have regular lower cost or market, right? For conventional inventory, right? Okay? Right? I shouldn't say conventional. For doing the basic cost, right? So it's different retail. And this would be LIFO retail. And then there's one more that just adds a level of kind of complication. What's that? Yeah, dollar value LIFO at retail. Use retail. So we do retail first, and then we do the dollar value LIFO. Okay? Okay. That's what we've got. Okay, guys? So we're gonna run through all of these. So let's take a look at a few of the exercises. Let's use exercise 919. I did something wrong. That says convention. Maybe they didn't have a problem. They did the average.
What about the one before that, 18?
The one before that, 18
says
average.
A says compute the ending inventory at retail.
Okay, that let's try 90. Let's not do 919. I thought that one was at retail.
I think A, all you have to do is just do the same thing. I think there's only convention.
Well, they show you in the book how to do it. conventional, LIFO, conventional, and LIFO, LIFO retail, LIFO retail, LIFO retail, LIFO retail. I just wanted to show you just the difference. Let's take a look at 918 real quick, and then the ones obviously that are used more are the conventional and perhaps the LIFO one. Let's see, so 918. That's just getting it down to retail. It's not giving you the percentage. Let's do it this way. What's the key distinction between these different methods? What's the key distinction between these three different, or all of them? Between these different methods? What's the key distinction?
The way they calculate the cost of retail percent.
The way they calculate the percentage. That's it. Okay? So what do you do to calculate your percentage if you're using each of these? What would you do? And this one is similar to that one. Okay? What would you do between average, conventional, and LIFO?
Well, for conventional, you only consider the markup. Just once you get your markups and then don't include the markdowns, and then find the percentage, and then subtract your markdowns on your sales.
So to get my cost of goods sold percentage, right?
Mm-hmm.
My cost percentage, right? Here I'm using both markups and markdowns. And if I have, by the way, what if I have a markup cancellation? Or I have a markdown cancellation? What would I do with those?
And it's just net of those, right?
Just net them out, yeah. So if you've got markups and you cancel them, take the difference between it, right? You didn't really have the markup, but you canceled it. And the same thing with markdowns, you have markdowns and you have cancellation, just net them, right? Just get the net of each. So they'll give you those, that's fine. So that includes both, and then as you just said, what's the deal on lower cost or market? When I'm doing the percentage, only use what? Markups. What do you do with the markdowns? Leave them out, but you're going to still have to subtract them, right, to get your ending inventory, right, because they existed, right? You still got to subtract to get your ending inventory, but for doing your percentage, you're only going to include the markups, okay? What's different about LIFO retail? We're going to use both on LIFO retail, aren't we? We're going to use both markups and markdowns on LIFO retail, but we're going to separate the beginning inventory from those you purchased. So we have a LIFO layer of inventory, okay? So what's the key thing you got to keep in mind here? When you do the conventional, only include the markups, huh? You're getting your percentage. That's it. When you're doing the LIFO, separate the beginning inventory from everything you bought during the period and do two different percentages, okay? Now, tell me what you think leaving out the markdowns will do to the percentage. What do you think will happen there? Let me look at this exercise for that. If I were to do percentages here on these things, is that what they did in Part D? Excluding both markups and markdowns. Excluding markups, excluding markdowns. Yeah, okay. So, what will that do? If you include both, what happens? Which numbers would you use if you included both? This is at cost, right? And this is at retail. By the way on that, do you know your beginning inventory at cost and at retail? Yeah, because you've been using this method all along, so you know what happened last year, right? Do you know what your purchases are at cost? Yes. You also have to know what you're going to sell them for. Does that make sense? Okay. So keep track of that. Why did they add markups in here and take markdowns out of here? And they didn't do anything on the cost side. What do you mark up? Your sales price. You can't change your cost because you change your sales price, right? So the markups increase the sales price. What do the markdowns do? Reduce the sales price. So you have a standard sales price, and if you run a sale, that's a markdown. If it's selling really well and you can get more out of it, that's a markup. Got the idea? Everybody sees what a markup and markdown is. No big deal, right? Okay. So what would you use if you're using average? If you're going to do the average, what would you use here? What percent? What relationships? You'd use both. So if I want to get the relationship between cost and retail, I would keep my beginning inventory and my purchases together, right? So keep them together. And what would I use? Both. So you take 284, 210, right? That's the sales price of the goods available, and divide it into 180. What percentage was that? If you use both, what do they get?
It's the
Number 4 down there. Okay, so if you're using both, you do 63%. Okay, and then when you calculate your in the inventory, you take 63%, right? I take 63% of my ending inventory, and that would be my cost on that inventory. Okay? By the way, we are calculating the ending inventory. We are not calculating cost of goods sold when we do this computation. Real important. Okay? So you're calculating the cost of goods sold. So it's the 63% one. Okay? That is. Okay, that one is the inventory. Let's see. Sales price of goods available, right? Compared to the cost, right, guys? Okay. What if I was going to use lower cost or market conventional? What would I pick up? Which number do I want? I want to leave out these markdowns, don't I? So I use this one and this one. What is that percentage? 310, 345. That's the 58%. Okay, now think about what will happen here. Okay? What will happen to you if you take, let's say your ending inventory at retail is 100,000. Compute your ending inventory at cost then, using those two. If you got 100,000 ending inventory at retail, let's say my retail is 100,000. What is it at cost? That's all we're saying. If you have a different estimate of the cost percentage, what's going to happen to you? If I take 63.33% of 100,000, what would I get? 63,333 is my ending inventory. Okay? And what I do is I take this total cost available, right, less that ending inventory, okay, to get my cost of goods sold. What would my ending inventory be, though, if I was using lower cost or market in this example? 58,000. What happens is you major, so that make my cost of goods sold more, right? My ending inventory is less, cost of goods sold is more. By the way, what would you expect lower cost or market to do to your inventory? Assuming that sometimes market is less than cost. What would you expect it to do? It would give you an estimate of inventory that is lower. So see, it gives you a lower one. So it's just kind of a rule of thumb type thing. I got a lower estimate of inventory by leaving out what the market is. Right? Everybody got it? Okay, that's it in the right direction. Yeah. Okay. Right? What would I do if it was LIFO? What would change if I was LIFO? Draw a line here. What's the percentage of the beginning inventory? You guys lied to me. Was that 58%? 180 divided by 310, 345? Yeah. Oh, okay. That's an interesting coincidence. Because what is it in the beginning inventory? 58%. It's 58%. What must it be on the added inventory? Like the problem there. We have to include everything, though. So it'd be all the rest, which would be what? 122. Right? We're going to use the 122 and what number? 210, 345. How did I get that? I left this 100 out, right? Okay, and we'll do one of these. So what's the 122 here divided by 210,345? What percentage did you get? Is it also 58%?
Did you include the markdowns in the line?
Yeah. Did I include it?
No.
Oh, I didn't. Oh.
It's 426.
So it's 284 less the 100. 184. Thank you. There we go. Good. So let's try that. The 3. So I've got 122,000 divided by 184, 210. What percentage is that?
66.
Oh, it is 66. It's different. Okay, good. It's just a coincidence that we had that 58%. So now what would I do? How would I value my ending inventory? I'd have a layer, which is 58,000, right, guys? Just pick that one up. Okay? And then what would I have new? The ending inventory at retail is 98,210. The beginning is 100. What's my new layer? Oh. So I have one layer, which is 100,000 at 58% to make the 58,000. I'd have a new layer, which is going to be what? Looks like 40,210. Is that right, guys? And what price? What cost are those? 66%. So how much is that?
You're giving them 40,000.
98 is your ending inventory here. Wait a minute. Line. Beginning was 100. They depleted their inventory. Never mind. Yeah, it'd be the 98 less the 100. So what would we have for ending inventory? I guess we could do that too. If you got the 98,210, what would you take it times? 58%. So this problem didn't work out. But if this number, the 98,210, was more than the beginning at 100, you'd have a new layer. Because it's less, you deplete part of your layer. My fault. Thank you. Okay, so 98,210 times 58% would be your ending inventory. We better work the problems correctly. I've never used that problem before, obviously. And I don't think I'll use it again. I don't get very well. They deplete the inventory. Okay, anyway. Whoops. Let's go down to, let's give 922 a try. Conventional alignment. And maybe on this one we'll calculate the regular retail, the average retail too. Okay, so work it out. See if it's real the last one. What do we do on the conventional here, guys? I got my beginning inventory at cost, right? So, by the way, set it up like they do. I think it's a good way to do it. Cost in a column, retail in a column, right? And you're going to be constant. This is 922. Okay? So I've got the cost listed, the purchases listed. I've got them at sales price, retail, and cost. Okay? And I'm adding in the markups, and I'm going to deduct the markdowns too, but we're going to handle it separately for getting our percentage revenue. Okay? So what am I going to base my percentage on, seeing as it's conventional retail? We're going to base it on the 169,000 of cost and the 260 retail, or am I going to base it on the 169,000 of cost and the 247?
260.
The 260, right? Which is going to give me what? When I do this, what's going to happen? 65%. What would the other one give me? That would be the average. If I was doing the average method, what's 247 if I did 160? Almost
68%.
68%. Got the idea? Okay. So it's going to be more. Okay. So let's write that down. They calculated for this problem 65%, which is using this one and this one, right, guys? I took out the markups, but I did not take out the markdowns for doing my percentage. So there's my percentage. I did that. Okay? Everybody see it? Seems a little crazy at first, but it does make sense. Okay? What would it be if I was using average retail? What would my percentage be?
Goes up to 68.
It'd be 68% because I use this one here. So then it'd be 169, whoops, this one here, right line. Yeah, 247 divided to 169, we said it was 68%. Okay. So what would happen to my ending inventory then, obviously? What is it if I'm using conventional retail? By the way, what's another name for conventional retail, guys?
Lower cost.
Lower of cost of market, yeah. So if we call it lower of cost of market, you know what it is, right? It's conventional. Okay, same thing. All right, if I use the conventional, the lower of cost of market, I just take my 65% times whatever my ending inventory is at retail. So I'm doing everything at retail. By the way, how'd they get down to the inventory at retail? Yeah, be sure and take out the markdowns. You're going to take out the markdowns no matter what, right? You got to take them out to get to your retail, your inventory at retail. You've got to include the markups and take out the markdowns to do that. Okay, you have to do it anyway. Okay, it's just relating the percentage when you take it out. And then they deducted their sales, which would be net sales. It's their sales, less sales returns and allowances, less sales discounts, right? Okay, and we get down to what? Ending inventory at retail. So now this 80, I just take it times the 65%, and I get 52,000 as my ending inventory at cost. What's my cost of goods sold here? What's my cost of goods sold with that method? It's pretty simple. What would you do, guys?
It's the beginning at cost minus the, plus the purchases minus the ending at cost.
Yeah. So it's what's available, right?
Yeah.
This is what's available. This is available goods, isn't it? Everybody agree with that? That 169 is what's available. What you started with, what's 38.1 plus your purchases, 139 is 169. Subtract your 52, and what's your cost of goods sold here? Okay, 117. Notice I calculated the cost of goods sold after I did the ending inventory. Do it that way. Don't take the sales times the cost of goods, or the sales times the cost percentage, right, to get your cost of goods sold, and then subtract that to get your inventory. Depending on which method you're using, that may or may not work, okay? And the markups and markdowns will screw you up, okay? With this one, it won't work. Where you include both of them. Don't do it that way, all right? Okay, so what if I did the average? What would it be? What's my ending inventory at average? What would it be, gang? 68% of the ending 80,000, right, guys? What's 80,000 times 68%? 54,737 maybe?
Yeah.
Okay, 64,737, okay? What's my cost of goods sold going to be? 169 times, oops, I'm sorry, minus that. 169, right, minus 55, 757, right? Yeah. What's that going to be?
114,262.
Okay. Which is more conservative? To have an ending inventory of 52,000 or an ending inventory of almost 56,000? Obviously 52. Which is more conservative, a cost of goods sold of 117 or a cost of goods sold of 114? 117. Got it? Lower cost of market is conservative. So there, should just use this one. Okay, what would I do if I'm LIFO now? How would that work? What happens, guys? It's exactly the same beginning inventory, exactly the same purchases in this problem, right? But look at that. They've got that guy separated. I am going to treat my beginning inventory as a layer, right? And then that's my old layer. And then the purchases are the new layer. Everybody got it? So what I'm going to do is I'm going to calculate a percentage for the beginning. What's my percentage on the beginning? What's 38.1 divided by 60? 63.5% maybe. Okay, and then I'm going to do one on my purchases, right? So here's my net purchases, okay? And here's my at cost. here's my net purchases at sales price, but I also had markups and markdowns. See how I said we're doing average here? It is, isn't it? You could make this lower cost or market, couldn't you? What would you do? Just leave out the 13. You do your percentage and take it out later. I won't make you do it. Okay? All right, I've never seen a textbook where they did it that way. All right, so, but you could, conceptually. Okay, so what I've got is the total added, so let's get my percentage for what was added. What's this percentage? So I got one here, and I'm going to do one here. What's 130,900 divided by 187? What's that percentage? 70%? Okay, they did it down here, didn't they? Okay, there it is. Okay. So, by the way, what happened to my cost of goods sold as a percent of sales is doing what? In this company? Going up. Yeah, it is. Okay, 70%. Okay, so you can see that, right? All right, anyway, so if I end up with an ending inventory at retail down here, like I did in that example earlier, right? The earlier exercise. If this was less than 60,000, what would you do? Let's say I had 50,000 left. I take the 50,000 that was left times the 63.5%, and I get my ending inventory with me. Right, guys? Everybody agree? Why? Because this is the old layer, and I'm using LIFO, right? And I'll deplete it last. That's all. Okay? Do I have a new layer here? Yeah, you've got a $60,000 layer here. Everybody agree? The beginning inventory is the old layer. What I'll do is at retail, it was 60,000. And I'm going to take it times the cost percentage for that layer, right? Which is 63.5%. This is going to be obvious how it's going to turn out. But the point is, if you had less than 60,000 left, this is how you approach it, right? Okay? Is cost, my estimate of cost. So that was the 38.1, wasn't it? Everybody good? Okay. New layer, this is from this year, right? What we added. How much new layer do you have at retail? Yeah, 80 at retail less the 60 beginning inventory is 20,000. Here we go. And what's my cost percentage on that stuff? 70. So you're going to use the new layer. That's all. Okay. That's 14,000. So what's my total inventory? Okay, what's my cost of goods sold if that's indicated? The 169 available less the 52.1 ending inventory. What is it? 116.9. Great. We can do it, can't we? Okay, and notice, I'm going to go through a little calculation of it, right? They got the 52.1 that we did. There it is. Okay. Okay. There's the 52.1 right there. Everybody good? So you can get to 116.9, and with the other two methods, we had cost of goods sold of 117, right? Because we had a 52 ending inventory, or we had cost of goods sold of 114,263 with a 55,757 ending inventory. So you do all those. Probably could have before I started. Okay. All right, guys, wanted to get that one. And then, let's take a look at a dollar value, LIFO one. Let's try 926. Just adds one more layer of complexity. Okay, now on this one, what you want to do is you want to go through exactly the same process, get your cost, get your retail, right? Get your cost to retail percentage. Whoops, wrong part. That's another example of doing cost, doing lower cost per market. Here we go, part B. In this one, what they're doing is you are going to consider inflation, right? Changes in prices. Remember the dollar value LIFO that we did in the last chapter, right? You know, last chapter. We are figuring what's happening to purchasing power, okay? So what we want to do is we want to combine calculating our cost of retail percentage with deflating, right, the prices back to the base year, and then reinflating for the new layer. So this gets kind of hairy, right? But it's going to look exactly the same, right? I've got, by the way, you're still going to separate your beginning inventory, seeing as you're doing LIFO? Yeah, sure, okay. So you can see here they separated the beginning inventory in this problem. So they gave you beginning inventory is 130,100, retail is 50. Do I have a cost to retail for my old layer? What's 30,100 divided by 50,000? Remember, those are already deflated, right? What was it?
A little over 60%.
60.2%? The relationship between those two is 60.2%. And they've calculated it down here, although their calculation looks kind of funny, because obviously it's by one. Why is it by one? When they value it at the end. It's base year, yeah, so I don't know if you really need to do that, but they're taking it times the 60.2, and here's how they got the 60.2. They just took the 30,100 and divided it by 50,000. Very good? Not a real big problem. Okay, so then what happens? Notice they've separated them. Notice that line. Beginning inventory is separated from the new ones added, okay? So now what do we got? We got purchases for the year at retail. We have purchases for the year net, of course. You have less purchase returns and allowances, less purchase discounts, plus freight in, right? Okay, so if we give you that kind of stuff, pick it up. They add the markups, take out the markdowns, and what have we done? We left this at average, right? Which we did on the other LIFO method. Okay, sure. All right. So now what I've got is everything I added at cost and everything I added at retail. Okay? What's the relationship between those two? The current year. Current year cost, current year retail. What's the relationship between the two of them? 1085 divided by 155. What do you get?
70%.
Yeah, 70% was the add-on this year. Okay? Now all their examples, they got it all like the cost going up, the gross profit going down. But okay. So we got 70%, and that's where they got the 70% down here, huh? Okay, pretty good. So it's just whatever it is. All right. Then they're going to go ahead and at year-end prices. This is at year-end prices. They're going to take away, or I'm sorry, for the current year prices, they're taking away. Here they've added the beginning inventory plus the purchases. Take away the sales revenue, and you got the ending inventory at retail. Now, what's the problem that we have with that? We've had inflation, right? So they say in the problem, well, the inflation was 110%. So how do you get down to base year? How do we always get down to base year? Divide the index for the current year, right? We were dividing it into the cost. All we do is we divide it into the retail instead. Okay? So here's my inventory at retail, 78.1. Take the 78.1 and divide it by your inflation, right? Factor 1.10. And what do you have? Your price index. Now I've got 71. So what this is my base year retail inventory, right? At retail dollar amount, that's my base year inventory. Ready to follow what we got here? Okay. What are you going to want to do with that?
Add it to the original value.
Well, you're going to you want to do what? You want to pick up your new layer and your old layer, right? So I've got an old layer of 50,000 retail, which has a 60.2 cost, and that is 30,100. So what's my first layer, of course? 50,000. And it's, of course, it's base year, so that's why they use the 1, times the cost factor gives me 30.1. Everybody good? So that's just my beginning inventory. What if I deplete this one? What would I do? If I'm below 50,000, I'll take whatever it is times 60.2, and that'll be my ending inventory. Everybody agree? Just like we did with the other LIFO. Okay? The regular LIFO. Now I've got a new layer in base dollars, 71 less 50 here. Got it? 71 less the 50, I added a $21,000 layer. So here's the $21,000 layer. Everybody agree? But that's a $21,000 new layer at base dollars. So I want to reinflate it. So I took it times 1.10. Everybody see what's going on? And then I use my new cost percentage, 70 times that. So what is 21,000 times 1.1? At year-end prices, right? This is year-end retail.
23.1.
It's 23.1. So you can think about it that way, right? This is 23,100. And then my cost percentage on that new layer is 70%, right? So I'm using year-end dollars for the new layer, and I'm using the new cost percentage on the new layer. Well, yeah, they go together. Okay? So that's going to give me 116, or 16,170. Just add the two together. 46,270 would be my ending inventory at cost. And this time they did do cost of goods sold. What was available way back up here? 138.6. 138.6 less the ending inventory of 46,270 gives me my cost of goods sold. Now this one back here, well, I'm really quick today. Probably didn't do a decent job at all. Especially at the beginning. Get you organized. Really do a horrible job of teaching. It's true. Got you guys. Okay, so here we go. We did one of these. Part A is what? You can do this in no time.
Yeah.
This is 5 minute
Full
problem.
time for 2025.
Yeah, this is 5 minute problem. Wait a second. Maybe 10. Okay. By the way, I'll give you separate problems for each one of the different things, so that now it's going to start going crazy. For the most part, I think I did that. Okay. What's this first one here? Part of what they do. This is dollar value LIFO here, right? Using retail. Right, so we merge retail and dollar value LIFO, right? What's this one up here? This is conventional, wasn't it? Or lower cost of market. Okay? So what do you think? What? You handle this pretty easily? Beginning inventory cost, beginning inventory retail. There's our purchases, net purchases, of course. We include our markups. We do not include our markdowns until later, right? After we do our percentage. We get our percentage here, right? Because we're going to do lower cost of market. What's that percentage? I calculated 66%, didn't it? Okay? All right? What's my beginning percentage? I'm not going to separate it, but what is my beginning percentage? 30,100 divided by 50, what was it? 60.2. So here the cost percentage is going up too, right? Okay? But we don't separate it. Right, guys? Lower cost of market we don't, on average we don't, only on LIFO. Okay? So notice there was no line drawn between beginning inventory and purchases here. Okay? That's all. So now what do you want to do? Be sure and take out your markdowns because that is going to affect your ending inventory retail, right? So take out your markdowns and take out any sales. You've got to be net sales, right? Okay? So now I've got my 78.1, and they took the 78.1 times the cost percentage of 66, and that gives them their ending inventory of 51,546. And how would you get your cost of goods sold? So what's available, 138.6 less 51,546, whatever that is your cost of goods sold. Get it. Okay, questions?
Can you mention the cost of goods sold for the, B part B?
Did I do it wrong?
No, I just need to see it, yeah.
I think it would be the difference between the 138.6 and the 46,270, which is what they calculated. Right?
Yeah.
So all these different methods are going to give you different inventory estimates, right, guys? So what else do you want to do? 20 minutes. Why don't you do 9:15? Do that one shot. Well, before we do that, there was one more I wanted to do. It's really easy. 9:28. Take a look at that. John Oldrudy, a local retailing concern, Bronx, New York. Has decided to change from conventional retail inventory method to LIFO retail prices starting at January 1st, 2015. Everybody see that? They're going to go from lower cost or market to LIFO retail, okay? And they were lower cost or market retail, right? Conventional LIFO retail. You need to make a journal entry for this. The company reconfigured its ending inventory in 2014 in accordance with procedures necessary to switch. Inventory computed was 216. Assuming that the ending inventory of 2014 under the conventional retail inventory was 205, your credit appropriate journal. Make the journal. You got my opinion. It was 205. Now you want it to be what? 212.6.
Set the inventory 7,600.
I think so. And credit what? Cost of goods sold. What do you want to do?
Does it matter, can you only credit cost of goods sold if it's material? Or, if it's
not.
material, that's right.
Yeah, that's a bit of a problem. What do you have here? Change in accounting principle?
Yeah.
What do you do with changes in accounting principle? They're not material that hit cost of goods sold. If they are material, what would it? How do you handle changes in accounting principle? Where do they go? All right, what do you do with a change in estimate? It's the current period, respectively, into the future. What do you do with the correction of error? It's a prior period adjustment, right? Okay, so that goes to retained earnings. You get a change in current estimate. Same, you restate retained earnings, don't you? Right? Or maybe the next line on retained earnings statement. Huh. These guys do with this thing. It says debit inventory, credit adjustment, recorded inventory at cost. It says this account is an income statement account showing the effect of the change from lower cost or market to straight cost basis. Oh. So what's this? Is this a correction of an error? No. Is it a change in accounting principle? If it was, it'd go to retained earnings. What might it be instead? A change in estimate. You're estimating your inventory with one method, you're estimating it in another. And here's one of those things where you've got to decide. Do you think this, if it's immaterial, cost of goods sold, who cares, right? That could be cost of goods sold. If it's material, you'd want to have it in a separate line. And they're saying put it on the income statement in non-operating, I guess, or maybe you put it next to cost of goods sold and get your gross profit still. But disclose it, right? That would be what, if it's a change in estimate, huh? Certainly not pressure there, right? What if it is a change in accounting principle? Now you have to disclose it in your notes as a change in accounting principle, and that's what we've got. Is this really, and that was did hit retainer, is this a change in accounting principle? I agree with you out there now. As long as it's a change in estimate. But it's gray, isn't it, kind of, right? I can see people interpreting it the other way, okay? So they say it's an income statement account. That's where they want to put it. Adjustment to record inventory costs. Is that anywhere in the chapter? Nah. Right. He just made it up. I don't think so. He just made it up. Right? Be all kinds of names for that. Right? It's not really a loss, or I'm sorry, it's not really a gain, right? It's really an adjustment to prior year's cost of goods sold, except you made the best estimate you could, and now we get a different estimate, I guess. I don't know. Anyway, interesting stuff. Let's do one other one. Let's do the problem right before that, just for fun. I looked at this one too, and I thought I would have time to write it down. What they've done on this one is we've figured, they have figured out for you what all the cost or retail percentages are. And they gave you all the year-end price indexes. This is on 9/27. And they gave you 4 years. Okay? So you know how to calculate all these current year cost per retail percentages, right? It's the additional purchases and the sales price of those additional purchases, right? And the sales price is adjusted by both the markups and the markdowns, right, guys? And so that's the new purchases. And so they got all those percentages. Goes from 57 up to 60, up to 61, down to 58. That's where those came from. And then you know how to get the price index, right? It's on what it costs to buy your inventory in the base year compared to the later years. You can calculate that yourself, or you can use a general price level index, right? Consumer price level index or retail price level index, or maybe your industry price level index. You know how to get those too, right? Okay, and they're usually given to you in these problems. So they've given you both of these, and then they've counted the ending inventory at retail. So what this does is it kind of messes with the layers. So what happens here, you guys? I've got, in the base year, I have how much? What's my base year inventory up at the beginning? Let's just say we started with $100,000 that cost $54,000. Everybody agree? The base year 2012, right? Retail was 100,000. Is that right? My cost percentage, 54%, was it? Yeah. So my ending inventory was what? $54,000. So that's where I'm starting, okay? That's obviously what they did here, right? So that's my base layer, okay? In 2013, what would you do? You've got 118,720, it says, that cost you 106. So 118,720 that cost me $1.06. It would have cost $1.06 in 2013 to buy the same thing that I could buy for $1 in 2012, right? All this price index means, remember that stuff? So 106 into 18, I tell you what it's like, you've always known it, don't feel that way. 118,720 divided by 106 is what? 112. Okay, now that's at retail, right? We're talking about retail. This is retail over here, right? Restate to base year retail. So this is retail at base year now, right? So what's the first level? Well, it's the beginning inventory, 54,000. There it is. And they calculated it. 100, obviously, it was base year, so it's 1. At 54% is 54,000. How much additional do I have? If it's 112 at base year, and 100 was my beginning inventory, there's 12 more at base year. Everybody agree? That's all it is. 12 times 106, and the new index, 106 is the price index, 57 is the new cost percentage, so my new layer would be at the 57%, 7250, and I get my ending inventory, and I get calculated for cost of goods sold using that, right? What do you do if you go forward? Well, here we go, 138,750 is 111 at that point. I get it down to base year, and now I have three levels. There's the 54 coming in back here, right? There's a 7250 layer we added because 125 obviously is more than 112. So I've got one more layer. There's 112, and now I got one more at 13, inflated at 1.11, and take it times the retail cost percentage for that year, 60%, 8658, and now I got 69908. Now what happens if I deplete layers? Which ones go first? LIFO, the most recent ones. So I'm going to get rid of this 13,000 in base year from the beginning and work my way backwards for the last one, work my way backwards. The next year when I take my ending inventory at retail and deflate it back to base year, now I got 115%. I get 109, which is obviously less than 125, it's even less than 112. So what do I have left? The 54,000, which is the 100 at retail, right? The base year. And then I only have 9 more to make the 109 total. So that would be 9 from the second year, 106, right? And 57%, there it is. So that's 5438. Get the idea? 59,438. It's a big deal. And then in the next year, 2016, when I deflate, now 125% of the base year to buy something, I got 162 ending at retail in that year's dollars in 2016. Base year, that'd be 130,000 inventory. Can I get these old layers back that I depleted? Nope, they're gone. So what you got left is the 54 plus the 5438 from the prior year, right? That's 109,000 from the prior year, right? So how much more do you have to make up 130? That's 130 less 109, 21,000 more. Reinflated it to 1.25 and take it times the cost percentage for that year, and the last year was 58%, I guess. 15,225. Could you pull something like this off if I asked you to? Not too bad. After you do a few of these in base, dollar value life will take it up. Yeah, if retail to it. Like if you want it's just regular dollar value life, no big deal. Huh? Retail just has a layer.
These solutions on our middle page.
Yeah, they're on the Moodle. That's what I have up here. They're all on the Moodle. So you can just crank through it and look at it, think about it. Okay? Everybody good? Okay, try that one in cost one. Try it. Close profit.
9:15.
What was it?
Is that what you said, 9:15?
9:15, probably. Yeah, that's good. That's real typical type of thing, right? What do they got there? These guys have, they didn't know that. They don't know how to install them because they're not keeping a perpetual inventory. Yeah, it should be real quick, real quick. These are easy, I think. Actually, maybe all of them are easy once you can do it. It's just hard to keep straight on some of it. Exercise 9. You just want to get your cost of goods sold percentage. Take it times the ending inventory and the sales price. What do you call it?
Tim Duncan on Spurs.
Oh.
That's really nice.
Somebody's a basketball fan.
Yesterday, I have like Indigo Girls Company.
Yeah.
They have like 5, but it's like Phil Collins.
It is.
I've seen like
Is it really?
at least,
Five. Somebody
at least
named Phil
3
Collins.
that's called Phil Collins.
Fashion company.
Sheep laws.
I would ignore the company name.
They're gonna use real company.
Then they have to use real data.
For sheep laws companies.
That's so weird. That is awesome. Must be
Some grad student having some fun, and some PhD student that doesn't have a life, so it's trying to get their kids naming them. Everybody got in a number? You certainly don't want to stay late after I got done 20 minutes early, right? Give it to Carol. Sit down a little, basically income statement. Sales, cost of goods sold, and gross profit. Calculating the inventory. Good like that. Again, plus that's cost of goods sold, what ending should be compared to what it is, both lots. Right?
What's the answer?
I don't know.
Did you ever pull that?
Yeah. I didn't look at it yet.
Oh,
What's beginning inventory?
38,000.
What did they buy?
$80.
What did they sell? Need our sales, don't we?
112 net.
Our sales is 112 net. You did your sales, less your sales returns and allowances, less your sales discounts, whatever you got. 112.
And they're selling at the 40% over cost.
40% over cost. So the sales is 140% of cost.
Yeah.
That is, you divide 1.4 and then you get your cost.
71.4% times.
Oh, 71. Oh, you did a percent. Just divide by 1.4. I'll do it too. What I suppose.
Yeah, that works.
What's 1.4 in?
I think I got 80.
So you took 1.4, you divide into 112, it's 80.
80,000.
The other way you could do it, the other way you could do it is you could say this is 40%, right? This guy in here is 100%. You guys good?
Yeah.
And you could convert. You could take the 100, right, and divide it by 1.4, and what do you get? This is the cost as a percent, right? It's markup on cost. And this is the margin. No, it's the margin. This is 100% of itself. So 140 into 140 is 100%. It was 140 into 100. What'd you say it was? 70.
1.4. Yeah.
1.4.
71.4%.
Okay, good. Which means the gross profit percentage must be 40% divided by 1.4, of course, which is 28.6 or so. So anyway, 71.4 times the 112 still gives me 80, doesn't it?
Yeah.
Or the 80 divided by 1.4 gives it to me. So my gross profit, we don't care what it is, but it would have been 32 what we sold this year. Okay? Key number we wanted was the 80, and that's the 80 coming under here. So what's the deal now?
Ending inventory should have been 43.
Okay, now, was there consigned inventory in this
Yeah,
one?
there's 6,000 consigned.
What about the consigned inventory?
That you can't include it.
Your client reports the goods on hand were 30,500. Whoops. Yeah. But you determine on July 16th cost, but this figure includes goods of 6,000 received on a consignment basis. Okay, so,
Isn't that,
and our insurance covers only goods owned. So our claim against the insurance company would just be for the ones we own.
yeah. So
Right?
you remove that from the final count.
I would think so, yeah. So the 43 is, we thought there should be 43, and there's 35,000, or 30,500 still on hand. But you'd have to take a 6 out of there, right?
So it's 24,500.
Well, no, wait a minute, if we took the 24.5 away, that'd make our loss be 43 less to 24.5.
That's what the loss should be.
Yeah,
That's the full loss, but we can't recover the 6.
Well, yeah, you subtracted,
the 6 from 35 and then
Is the 6 included in our 38 here, and
Yeah.
the 6 included in the 43?
yeah, the figure includes.
It would be,
the
right?
6,000.
The 6 would be included. And was theirs not stolen? Or stolen, we don't know, do we? That's a problem. If we kept our consigned inventory separate, we should know. So it's kind of hard to do this problem. If the 43,000 all is the whole inventory including theirs, which means ours is 37, right? And theirs is 6. Okay, if you think of it that way. Ours is consigned. It's consigned in, of course, right? Not out. If it's consigned out, we wouldn't have lost it. Okay, consigned in. This is 6 apparently, and this is 37. Would you guys agree with that? See what I'm doing? Because the total is 43 here. The deal is, if the ones that are left, we don't know which ones they are. If the ones that are left are these, 30,500, right? Okay, what would be our claim? It'd be 6,500, and then guess what? These people with this consigned inventory would come after us. I don't know why we didn't insure the consigned inventory unless they're supposed to. The agreement is they have to cover their own inventory. Well, then they collect from their insurance company, right? Or if this 6,000 or the 30,500 is only 24.5 that we lost, and they lost their 6,000. You guys with me? I'm sorry. We still have 24.5 of ours. And we have 6 of theirs. They have no loss. But what's my loss now?
18,500.
Well, 12.5. 6 plus 37 plus 24. Yeah, 12.5. 6,500 plus 6,000.
Why? I pulled the 6,000 out of the 30,500 that's there.
That'd make it 24.5
Yeah.
of ours that's missing.
yeah.
And we still have their 6. So 37 less 24.5. Ours should
Wait,
still
I
on
thought the
37.
24, you still have the 24. Like that's what you had left.
You
Yeah.
have
You subtract-
30,000. No, well, no. They said there's
It's included.
30,500 left.
Yeah, and then you subtract the
6 of it could be theirs. We don't know whose it is. 6 of it could be theirs and 24.5 ours, or all 30,500 could be ours, or anywhere in between.
Okay.
So they made the problem really screwy, didn't they? Right? So our loss is somewhere between 6,500 and 12,500. And the people who consigned it in with us, their loss is somewhere between 0 and 6,000, right? And the total loss adds up to the two of them put together,
So
which is a total of 12,500 missing, right?
I got 18.5.
Yeah. That's,
Isn't it 43? 43 we estimated the
well, like, none of that includes the consigned inventory up there to get that 43.
And I
So
thought
that's,
this would be,
I wasn't getting inventory.
well, they said 18.5 too. 38 less 85 for 123. 80 is the sales, 43. Oh, but they took the 6 out. I guess I read it wrong. The goods on hand,
Because it's included in the.
It's kind of gray.
Yeah, look at that note too, the note saying.
yeah, there says, depending on the details of the assignment agreement and Douglas insurance policy, tank goods might be considered owned for insurance purposes, and then it's 24/5.
Really?
I think the loss is 24/5. It's whether 18/6s are claimed against them or the whole thing. Yeah.
I can see why it's a complicated issue.
I read
I
that.
don't want to. Let's just throw it out.
Yeah, really. See you guys. Steady, steady, steady. Quiz tomorrow, huh? Yeah.
I was curious.
I did, didn't I? Yeah, that's what I thought. Did I give you back?
You already gave me back that.
I got action from somebody, I remember that it was so long. Somebody's got writing on it. Writing all over it. Did I give you your handwriting? Did I give you a blank one too?
I kept sliding.
I was just dumb. I gave somebody a blank one in case you can turn that.
I really go. I didn't see anything up. It's all put on. Either tomorrow or next week. Forward, especially, just whatever.
Yeah.
Appreciate it.
Month is not gonna work.
Okay. All right.
Yes, that's not.
And I'll get that letter done for you.
All right, thank you.
Go on Friday night, later show. At Nancy's Bagels.
Bagel.
You ever been there?
No.
It's really good. It's like a local. They're all not that local like. But it's
Yeah,
on-
everybody
yeah.
uses food.
Yeah, and it's on Frankfurt Avenue, I believe. It's for the trolley.
Oh, okay.
So, but yeah, if you want to come out.
Writing.
This, yeah.
Yeah, I
20
don't know if I'm gonna do much.
Yeah, I know it's pretty short notice.
I got 2 reviews. What time are you playing?
It's like six or 7.
Nancy's Bagel.
Mm-hmm. I just figured I'd let you know.
Yeah, thanks. Yeah.
But-
Yeah, I don't know what's going on.
Yeah.
But we're getting close to our trip, so.
Oh yeah, that's
Nancy's
true. Yeah.
Bagels.
You should
Yeah,
go
we
there
got
sometime.
grandkids, so.
If you,
Pretty cool, huh?
yeah, if you don't, if you can't, which I would.
They don't have any alcohol.
No.
You think it's on Frankfurt?
Yeah, it's over on Frankfurt.
Yeah, it might be fun. And
But
about
yeah.
6 p.m.
Mhm.
6 or so.
6 or 7. But yeah, if you don't make it out, you should still go over there sometime because that's where our guitarist's girlfriend works there. And
Ah.
it is the best bagels you'll have. Like, they have the best. My favorite is the everything bagel, like the one with all the seeds and everything on it.
Yeah.
Oh, it's so good. And they have all these different kinds of cream cheese. The veggie cream cheese with the everything bagel is the best. Or you can get a chicken salad sandwich on a bagel. That's really good.
Yeah, my wife might want to do that. She loves bagels.
Yeah.
And I never take her to get them. I'm not a big bagel fan. I like them, but I don't know. It's just not something that I.
Yeah. It's not something you're like, oh, I'm gonna go out and
I'm gonna go buy
bagels.
bagels. Yeah. Yeah. If she brings them home, I eat them.
Yeah.
Yeah.
These are really good. They're abnormal bagels. Like they're top of the line. Especially the cream cheese too. It's really good.
So how long you playing for?
Probably like an hour, I would say.
Are you the only one?
I think so. I want to say. I don't even know what trolley hop is. They
Well,
just told me it's.
Trolley hop is they ride up and down on the trolley and they go to art galleries and they go get something to eat and they drink and they.
Okay.
And you don't have to drive. And you ride a
Oh,
trolley on
okay.
wheels.
Yeah,
You know,
that
it's
makes
not
sense.
really a trolley car, but
Yeah.
it's that bus that looks like a trolley.
Mm-hmm.
And they ride it up and down. Yeah, it's kind of a nice thing, I think.
Yeah.
So,
What is it, like once a month or something?
I don't know. I've never done it.
I know that.
I'm not social, so I would never, in a million years,
Yeah.
get in a trolley and ride up and down the road.
Yeah.
I might get on it because I wanted to go somewhere, but I'm not gonna
Yeah.
make a night of it. Gee, let's go out and ride around the trolley. No.
Yeah.
Yeah. So,
Sweet.
yeah, I don't care about the trolley hop people, but it gives you a crowd.
Yeah. Oh yeah.
When they all show up at once. They'll
Uh-huh.
come piling in, so you guys need to be ready to play.
Yeah.
When they all pile in, you'd be playing as they get off the trolley, right?
Yeah.
And then when they leave, you can quit playing.
I really hope.
Place to clear out.
Yeah. I really hope they're drunk too, because everybody always seems to like our music a lot more.
Well, everybody likes everything better when they're drunk.
Yeah, I guess everything's better when you're drunk.
Yeah.
So,
It's the basic understanding, yeah. That's sad, isn't it?
yeah.
Might be some truth to that, though.
That's how it was this weekend. Everybody was just wasted, like watching all the acts. And everything.
Yeah, I don't know, they drink way too much and they drive.
Yeah,
That's
that's
not a good thing, but I don't think there's anything wrong with drinking, obviously.
Yeah.
So, I don't think it's terrible, but,
Mhm.
you know, dangerous, let's put it that way.
To me, it's like anybody could get up there at a music festival and just do whatever, and people would like them because they're drunk. It's like get up there
Yeah,
and
and
play one song.
another reason I like concerts better, you know, where I have a chair for one thing.
Yeah.
And I have good acoustics
Mhm.
and all that stuff, and the bands tend to be more serious because
Yeah.
you guys know that, right? You know,
Oh,
the
yeah.
crowd is-
Well, there
You
yeah,
know.
there was some good bands, but I saw probably like 3 this weekend that I was like, okay, I don't know how they got into this
Yes,
festival.
we're a lot better than they are.
Yeah.
They got into,
Well,
they wanted somebody who was really cheap, probably.
yeah. I try not to think that. I try not to be like, oh, we're better than them, but I don't know. There was a few a day